The night is always at its quietest just before the storm breaks. Imagine waking up one morning to find the credit card you rely on every day is suddenly declined. ATMs stop dispensing cash, and on the glowing monitors of trading floors, red. Numbers are in a free fall with no floor in sight. This isn't a Hollywood script. It's the brutal reality that once paralyzed Athens, Buenos Aires, and Caracas. Canada, a nation that prides itself on stability and safety, is it truly an untouchable oasis? With household debt at record highs seeding, 180% of disposable income, the Maple Leaf economy is standing on thin ice. All it takes is a single crack in the housing market or an interest rate shock from the Bank of Canada bark for the entire financial architecture to shudder. We often look at the skyscrapers of Toronto or the bustle of Vancouver as symbols of prosperity. But beneath them lie massive financial levers. The question is no longer if it will happen, but when. Credit default swaps, CDS, the insurance against bad debt begin to spike. How will Canada take the hit we never prepared for? The first signs of a crisis rarely arrive with a bang. They emerge as silent fractures in the liquidity system. Observe the yields on Canadian government bonds and their spread against US Treasuries. When international investors begin to doubt debt servicing capabilities, borrowing costs soar, driving mortgage rates to unsustainable levels. In cities like Toronto or Vancouver, where real estate has long served as a store of value, a mere 10% drop in home prices could wipe out billions in equity, creating a domino effect on commercial bank balance sheets. Consider the lesson of the 1997 Asian financial crisis, when the IMF had to intervene in economies that were once overheating. In Canada, the danger signs are clear in the debt-to-GDP ratio and an over-reliance on foreign capital to sustain the housing market. When hot money flees, the sudden cash drought will suffocate small businesses, and for sale signs will proliferate across neighborhoods with no buyers in sight. This is when confidence, the most vital, invisible asset, evaporates, replaced by a fear that haunts the trading floors. The mechanics of an economic shock follow a ruthless law. The collapse of trust leads to a credit crunch. As systemic risk rises, banks stop trusting one another. The interbank market freezes, and liquidity vanishes. For Canada, an open economy, heavily dependent on resource exports and real estate, this shock typically hits from two sides. On one hand, falling oil and mineral prices severely deepen the budget deficit. On the other, the bursting of the domestic asset bubble leaves citizens tightening their belts. Visualize this through the lens of Greece in 2010, when public debt spiraled out of control. The government lost access to capital markets, while Canada's public debt remains manageable compared to the G7. Its private debt is a ticking time bomb. When the BARC raises rates to curb inflation or defend the CAD, debt servicing costs eat away at disposable income. The result is a deflationary spiral: lower consumption, lower corporate revenue, mass layoffs, and rising non-performing loans, NPLs. It is a negative feedback loop where every individual effort to save inadvertently pushes the broader economy deeper into the abyss. To grasp the severity of what Canada might face, one must look at the global map of past crises. Turkey and Argentina serve as expensive lessons on letting inflation and exchange rates slip out of control. When a local currency devalues, the purchasing power of the citizenry is annihilated, and foreign capital flees in panic. While Canada possesses one of the world's soundest banking systems, according to the World Economic Forum. Complacency remains the greatest enemy. Compare this to the 2008 subprime crisis in the US. While Canada emerged relatively unscathed due to tight regulations, the current context is entirely different. Canadian home prices are now significantly higher than they were in the US at the 2006 peak relative to income. If a Venezuela-style scenario occurred where a collapse in commodity prices leads to total economic catastrophe, Canada would find itself alone in a global currency war. The difference here is that Canada cannot print infinite money without collapsing the CAD. History proves no nation is too big to fail, and economic models built on debt always face a day of reckoning. When cheap capital ends, when the storm hits Canadian shores, the first impact will be a profound deepening of the wealth gap. The middle class, those carrying variable rate mortgages, will bear the heaviest burden. In major urban centers, the dream of home ownership will turn into a financial nightmare as net worth turns negative, meaning the mortgage exceeds the home's actual value. This doesn't just damage psyche, it directly paralyzes the financial system. The Big Five banks will be forced to set aside massive loss provisions, reducing their ability to provide credit to productive sectors. The CAD is likely to depreciate against the USD, making imported goods from food to technology more expensive than ever. This is an inflation tax hitting every citizen's pocket directly. A consumptive-based economy like Canada's will see stagnation in services and return. Energy-dependent provinces, like Alberta, could see double-digit unemployment, reminiscent of the 1980s recession. The social stability that is the pride of Canadians will be tested as public services are slashed to prioritize saving a financial system on the brink of insolvency. The response of the Canadian government and the Bank of Canada BARC in this scenario will be a high-stakes tightrope walk. The BARC will face a classic policy dilemma: cut interest rates to save the real estate market and stimulate growth, or raise rates to protect the CAD and prevent imported inflation. If they choose to bail out the housing market through quantitative easing, the risk of hyperinflation as seen in Turkey becomes real. Conversely, over-tightening would push millions of households into bankruptcy. The federal government would have to launch massive bailout packages, similar to the pandemic era, but this time with a depleted treasury and surging public debt. Look at Iceland's 2008 experience, where the government was forced to let major banks fail to save the real economy. Will Ottawa have the courage to make such a painful decision, or will it continue to provide oxygen to institutions that are too big to fail? Capital controls might be considered if capital flight accelerates, but this would signal the end of Canada's international credibility for decades to come. For the individual, the survival strategy in a crisis is not found in speculation, but in risk management. The lesson from those who survived the 1997 Asian financial crisis is that cash is king. In a liquidity crunch, maintaining an emergency fund in highly liquid assets is a matter of survival. Diversifying investment portfolios beyond Canadian borders, rather than keeping all eggs in the domestic real estate basket, will serve as an effective shield, reducing financial leverage. The moment warning signs appear is paramount. Those with the least debt will have the most options when the market plunges. Furthermore, investing in one's own skills and capacity, an asset that cannot be seized or devalued by inflation, is the most effective long-term strategy. In a crisis, the value of paper assets can vanish, but the ability to create practical value will always have a market. Look at how citizens in high inflation countries like Argentina adapted by using hard currencies or digital assets to preserve their labor's value before it was too late. An often overlooked but crucial aspect is the herd psychology of a crisis. When a small bank falters, a bank run can spread across the entire system, even if the major banks remain solvent. Panic is more contagious than any virus. In Canada, the Canada Deposit Insurance Corporation, CDIC, only protects up to a certain limit, and if the crisis is large enough, even this fund will be challenged. The breakdown of domestic supply chains due to a lack of working capital will leave supermarket shelves empty, a sight Canadians usually only see on the news from distant lands. This is when the essence of the real economy is revealed. When the numbers on a screen no longer matter, only food, energy, and community connection hold value. A crisis is not just a financial event. It is a painful but necessary purge of weak entities and business models built on phantom debt. However, the cost in human suffering is immeasurable, leaving a psychological scar on an entire generation regarding their perception of safety and prosperity. Looking to the future, if Canada undergoes a deep correction, the economy will never return to its old state. The growth structure based on immigration and driving up land prices will have to shift toward a more sustainable model based on productivity and innovation. Lessons from the collapse of former economic tigers show that nations that recover fastest are those that can restructure debt transparently and quickly. Canada has the advantage of abundant natural resources and a highly educated workforce. These are the foundations for rebuilding from the rubble. However, this shift requires brave political decisions, accepting short-term pain for long-term stability. We must question the sustainability of a financial system where home prices have outpaced income for decades. A crisis, however devastating, is also an opportunity to redefine national value, moving from a speculative economy to a true production economy, where prosperity is shared based on real value rather than the inflation of asset bubbles. When the next chapters of world economic history are written, will Canada be remembered as a beacon of stability or a textbook example of complacency in the face of systemic risk? The journey from flickering CDS numbers to the changing lifestyle of every family shows that economics is not a collection of soulless charts, but the heartbeat of a society. We have traversed examples from Greece to Venezuela to see that no system is invincible without prudent management and preparation for the worst-case scenarios. A crisis, if it occurs, will be the ultimate test of the people's resilience and the wisdom of those in Ottawa. It will force us to face the truth. Prosperity built on debt is merely a castle of sand before the tide of interest rates. When the lights of the office towers on Bay Street dim and silence falls over the trading floors, will we have the courage to build a fairer, sturdier economy? And the most important question for you, observing these developments: if the financial ice shelf officially collapses tomorrow, are you ready to avoid being swept away? Or do you still believe it could never happen here?